Good morning, good afternoon, and good evening to all of you legends of the smoking barrel. I'm Rustin Edwards, based in Geneva, with my illustrious world-traveling co-host, Mr. Matt Stanley, out of Dubai.
Yeah, 4th of July, man.
4th of July. Happy Independence Day to all those American listeners out there enjoying your barbecue, your fireworks, or your drone display, depending on what regional municipality you live in. Drone displays, that's probably become the new thing. So maybe we should go invest in drones with lights on
Yeah,
them.
drone zones.
Like I
Yeah,
say,
happy 4th of July.
you are single-handedly contributing to diesel demand or jet fuel demand in the world with all the traveling you've been doing this recently, last 3 weeks.
Yes, I mean, well, look, someone's got to do it because the Chinese aren't doing it. No, that time of year is obviously there was a big holiday here. Eid Mubarak to everyone who celebrated it last week. I took the opportunity with a long holiday to go back to the UK. Man, I tell you, UK airports suck. And I just suck. And it was just, honestly, it was grim. I don't know whether that's because I'm spoiled, but like I'm flying out of BXB all the time, or just investment in the UK just is just not there. It's exactly how it was 4 years ago. I know we went through this thing called COVID, if anyone remembers that, and it's a big pandemic. But the difference in what has happened to economies in the middle, compared to UAE, I know, an oil-based economy, trying to move away from that now, diversify into other sectors. Tourism doing very well, of course, Dubai. But the UK, man, it just parts of it were lovely because it's a lovely country. Born and raised there. I'm a Londoner. I went up to Suffolk to see my parents. Beautiful part of the world, but it needs a massive investment boost. Everyone's moody. But no, it was great. Yeah, I love UK.
And I think it's probably more of an impact of the cost of living crisis that's been hitting everybody, especially the EU and the UK and in the USA. But here we are today, July 4th. We've got range-bound markets. I mean, crude oil has been basically stuck between 71 and 77 since the better part of May. So we're heading into the third month now of a range-bound market with no real shift in sentiment going one way or another, despite the best efforts of Saudi Arabia, Russia, and Algeria to kind of support the market, as they say.
Well, I mean, Algeria, 20,000 barrels a day. Thanks very much. I mean, that's like coming on as a substitute in the 93rd minute and claiming that you won the cup. I mean, thanks, Algeria. Look, my colleague Victor was on Bloomberg yesterday when the cuts were announced by Saudi, and I completely agree with what he said. Saudis don't have a choice. I wouldn't go as far to say that they back themselves into a corner, but it's clear on the objective is to keep prices as high as possible or as close to that magical $80 a barrel, which the IMF have got as a fiscal break even for the budget. Look, I don't want to get boxed. I love living in the Middle East, but this podcast is to talk about realism. The rhetoric that's come out of Saudi and other members, no, mainly Saudi here, to keep traders on their toes, to keep traders guessing, for those who short the market, to keep them ouching. I just don't think it's helpful whatsoever.
Well, it hasn't changed their positioning, because if you look at the recent CFTC data, shorts have actually increased in WTI and Brent.
Correct. I just think what it does, it just unnecessarily takes away integrity from the group. To have a sort of alpha attitude that you want to pervade to a market that, in essence, needs liquidity to go up or down, depending on market dynamics and economic sentiment, I don't see why selling a market would be treated so negatively. Of course, like I said, oil, Saudi is largely reliant on oil income to balance revenues, but to summon the whole market over as they have done this week, everyone's gone and people still listen to the group that still control a third of the world's oil. It was only the 3rd of April this year where we saw those big surprise cuts of 3.6 million barrels a day. Everyone was like, oh, this is the boost up to 80. No. I mean,
get it to 85.
Yeah. Okay. Well, yes. Right. So this is where it comes to difficult questions, why people have been not invited. The Bloombergs, the Reuters, the New York Times, the Wall Street Journals are not invited to Vienna because they'll ask questions perhaps people don't want to answer. Now, the reason for this forum, i.e. you and I, the Smoking Barrel, and you legends who watch it, is to talk about those things. That's the whole idea of capitalism, of free markets.
That's the whole idea of markets in general, is that you have to listen to the other opinions and derive your own trading mindset around what you hear and what you see from data. I mean, when you look at the overall data that's come out in the last couple of weeks, world PMIs for manufacturing, pretty much all in contraction, except for a couple of bright spots like India, which is having a great benefit from cheap energy. Indonesia, again, they have a great benefit of cheap energy. But nevertheless, you've got a worldwide manufacturing slowdown, which impacts demand for energy, which impacts the consumption of different fuels. So you can understand if Saudi was, Saudi doesn't want to admit that we're cutting oil because of demand, because that would just put, I think, a nail in the final coffin and really cause a sell-off. To say that cutting oil to, we're going to make the traders feel pain, well, that's a bit more of, throw your dolls out of the pram, please.
Yeah, it is, and it's like a deterrent that they think that traders are naive. I mean, okay, we are quite a naive bunch, but we can read a chart and we can understand what it means, and then form an opinion to take a trading position. But essentially, if you were to look at the group from an outsider and think, okay, what is the objective of the group? It's to maintain stability in the market. Now, you and I would translate that as, well, it's fairly range-bound and boring. But if you're OPEC, mission accomplished, because it's largely been in from the 1st of May, we're at 71.82. We then hit a high of 78.40 at the end of May. We're now at the beginning of July, and we're slap bang in the middle at 75. Fine, that's stability. People can plan. The inflation argument comes under more and more control. Things only look expensive in retrospect because you always go, well, I was only paying that a year ago and now I'm paying 5 times higher. If you look back now over the last 3 months, I'm paying what I was paying before. Okay, within 5%, 10% tolerance, people can take it. And that, to me, is mission accomplished. The aggressive narrative coming out to deter people from taking certain positions, I think, is not helpful whatsoever. So we'll have to see not what the group do, because it's clear what that was yesterday, and it's put a floor under 75, arguably. I think 4th of July holidays, the market reaction was nowhere near as severe as what it would usually be. So I think that the timing is convenient. We'll have to see what the US do when they come out of their brisket and Budweiser hangovers tomorrow. But $75 a barrel, the world largely stable energy prices. Well done, job done.
Yeah, and it also, it kind of smacks in the face of their own analytics, because if you look at their own analytics, second half is supposed to be so much oil demand out there that, oh my God. So you're cutting supplies going into what your own analytics are saying is supposed to be a high demand period. So it does put a question mark into, at least my mind, how good is demand really out there? And I, as being the constant honey eating bear on this show, I'm still not thinking demand is as strong as people want to make it sound to be. Their actions are not showing that.
Yeah, I agree with you. Our guys, had a forum recently in Geneva.
Yes, they did.
and echoing what you're saying, that the second half story. Well, look, we're in July now. People are buying for September. Is demand there? Is it as great as people forecast? No, it's not. And you just got to look at structure on things like Brent, flats. That doesn't imply a strong strong uptick in demand. Mike Muller said the same thing on the Gulf Intelligence Forum on Sunday. Our guys looked at the structure. Kev, right, our mate, wrote a really good piece yesterday on diesel demand. Again, with structure flat, it does not imply what people were hoping for in the second half. So there has to be some adjustments. The OPEC need to adjust. We're now in the second half, and it's not as good as they were hoping. So are the cuts a proactive step because they are going to downgrade demand for the second half? I don't know, but probably.
Probably, but I think OPEC's got their biggest competitor right now is Russia going into the Far East, because that's where the biggest competitor for market share sits.
Yeah.
You've got the cheap Russian crude going into India, cheap Russian crude going into China, and they adjust their consumption habits based on what's going on. But that cheap Russian crude is really causing some people to question now the refining exports out of India and what to do with them.
Yes, and look, I feel a bit ranty today, so I apologise if I've been all ranty.
It's all right. You just got from holiday. You're all full of piss and vinegar. Come on.
Well, it was salt and vinegar.
Those fish.
No, look, I did have fantastic. They're so good, so fat. No, you're right. Look, I mean, this is another one. We've touched on it every episode, not just in season 2, but season 1. Feel free to go back and watch all those. They're all available on YouTube. Other streaming outlets are available. Like, comment, subscribe, by the way. Look, the Indian story is one, that we have touched on, like I just said, many times. It's Victor, our head crude analyst, big brain, quoted all the time. He came out, on Monday, he said India are at tops now, at limits on how much they can buy. Just purely infrastructure-wise, they can't buy any more Russian oil. Let's just look at the figures. June 2023, India imported a total of 172 million barrels of oil, 71 of which came from Russia. Now, if we go back to, let's go back to July 2021, India imported 5 million barrels of Russian oil, as opposed to 71 million barrels in June this year. The numbers don't lie, they don't speak for themselves, and we've mentioned this in the past as well, and I'm not tapping ourselves on the back, but maybe we should get a big slap, but the EU possible ban about buying Indian refined products is something that we've spoken about. The Spanish refiners Cepsa and Repsol have aired their concerns, and the US are next. There was a New York Times article last night saying that the US authorities are going to look ever closer about how much Indian gas oil they're buying, which is refined from Russian crude. What do you think? Do you think this has legs?
Well, under the parlance of what is the origin of a product, I mean, historically, it's always been at the refinery gate dictates the origin of a product, not the crude oil you're processing. Because if we wanted to start playing that game, then all the Indian refineries that were running Iranian crude should have been not allowed to export their oil into Europe and the United States because of the origin of the crude oil. So if government's going to start changing the well-regarded status of how refined product is defined, then not only do you have to cut Indian exports, you also have to cut Chinese exports.
Yeah. And
then you have to expand those export bans to not only just imports into the United States and India, but then all over the world. So any action along those lines to try to punish Russia is a Pandora's box. That would disrupt oil supplies and energy supplies, and you'll easily get to see price spikes where you'll go back to a $60 gas crack rather quickly. And all of those assurances that the U.S. government were giving all the trade shops to trade the Russian oil so that the flow continues and the economies don't get hampered, what happens with all of that then? I mean, when the U.S. government is actually asking your Vitols, your Trafiguras, and your Glencores, please trade Russian oil, please trade Russian crude.
Yeah.
What do you do?
Yeah. No. Look, I'm sitting on the fence. No, I'm not going to sit on the fence. I wouldn't do that. Wouldn't be all ranty of me. I agree with you. I think it's one of those stories that people will go, oh, we're going to do something about that, and then don't do anything about it. Because you're right. Ultimately, the consistency of global trade flow is what every economy will look at. Once you disrupt that, all you do is create volatility and disruption and spikes in inflation. So I think the overriding objective, especially for the US, regardless of what the State Department may do to the Treasury, is one of consistency, and to get rid of this albatross around the neck of every single Treasury minister in the world is of inflation and controlling inflation, and then what it means for interest rates. you know, one of the conversations that I had in the UK last week was one of ignorance in the, okay, the story this time last year was, oh my God, my electricity bill is £600 a month. It was 200 only 3 months ago. Now it is, oh my God, my mortgage is going to be £1,500 a month. It was 700, you know, because there is a looming crisis. And purveyors of doom, we're not the Daily Mail, but it's realism, isn't it? And I think that going back to the conversation when it comes to what the US do, banning Indian energy because of the threat that it may be of refined from Russian crude. Well, I mean, that's what we said before. You just get into a myriad issues when it comes to, okay, well, how far do those enforcements go? The only way that it could possibly happen is the population saying, we don't want to buy your oil, which they did with Citgo, right? With the PDVSA issues. So Citgo, obviously a big US petrol retailer, gasoline retailer, owned by the Venezuelans. And I would remember being in Atlanta not long ago, and people were queuing up at the Shell and ExxonMobil station, but the Citgo one was empty. So there might be something there, I don't know, but yeah, look, I just think it's nice to write about it, but no one will do anything about it.
Just, as the Citgo refineries never shut down, and they still produce their gasoline and diesel and put it into the U.S. market. So the ignorance of the U.S. consumer around what type, what molecule they're actually buying at their gas station. We can make a whole show on that to say that when you buy a molecule at an Exxon gas station, it doesn't necessarily come from an Exxon refiner.
No, but if they all subscribe to Kepler, they'd know exactly where everything's coming from.
Well,
plug, shameless plug.
That's a shameless plug, Mr. Stan.
Yeah, I don't care. I don't care. Other cargo tracking platforms are not available.
Well, speaking of cargo tracking, one thing that the change in Russian flows and the change in molecule flows around the world is something I want to call the sweet and sour differential in the world. Two anomalies that have actually developed over in the last couple of months, the last couple of weeks even. You've got high sulfur fuel oil in Europe at all-time high crack levels, the difference between the product and the crude. Negative single digits, possibly breaking into the positives.
Wow.
Which, if that happens, that's like the ultimate for a fuel trader, when you usually trade a product that's minus 30 US dollars a barrel and it's at +1.
It's got a few schizophrenic traders who will have an episode that when that happens. Cross.
And then you have on the other side of the barrel, you have Naphtha, which is at all-time lows. Minus 18, minus 17 cracks, $300 per ton gas naphthas, which is the difference between naphtha and EBOB gasoline. And it all does come down to a change in balance and flows around light and heavy barrels. When you think of Russia and the exports of Urals that went into the EU refining system are no longer there. And those barrels are now heading into the east, and you've got really no substitute other than Johann Sverdrup and barrels out of Seyhan. And as of right now, the KRG exports out of Seyhan still are not happening.
Still not happening, no.
So you have a lack of heavy sour crude oil in the European refining space, thus causing fuel cracks to go hyperbolic in the east-west to say you need to start exporting fuel oil from Singapore back into Rotterdam.
Yeah.
So it's quite an amazing shift.
It is, and this is, to put it into context, I'm just looking at European imports of DPP, dirty petroleum products. So 2 years ago, Europe imported 49 million barrels of DPP, 20 of which came from Russia. This year, June, that dropped to 35 million barrels of total imports, 5 of which came from Russia. So some of it is still moving. So most of it is centered around one country, and that is Turkey.
Right.
So Turkey has certainly found its way into the conduit pool of how you can import and store and export Russian material. That's clear for everyone to see. That is not me throwing anyone under the bus. That is fully available on public, websites. I agree. I don't know the answer to. I don't know where this goes, though. I don't know how high fuel oil cracks could go in Europe.
It is a question of how much demand there is for high sulfur fuel in Europe. I mean, when you have cracks as strong as you have right now, shipping demand, tends to try to shy away from high-priced bunker ports. However, if you have to fuel your ship, you have to fuel your ship, and there's really no other incentive demand point for high sulfur fuel really in Europe. You don't have utility demand that burns high sulfur fuel, except in some islands in Greece. Malta, where they burn still like I believe a 1.5 or 1% sulfur material, but nevertheless, your 3.5% sulfur fuel oil becomes a very tight molecule in that regards.
Okay, here's a question for you then. What if look, we all know the trade patterns change and the circus moves from one place to the other depending on one thing: price, right? Everyone is price sensitive. I don't care if you're buying a Mars bar or a lawnmower or a Ford Escort or whatever they're called now. If Turkey are the new import terminal for Russian fuel oil, what is to stop the Turkish Maritime Authority setting up a new bunker hub offshore Ceyhan, for example? Because the material could be Turkish origin, which is fine. And they've got all this fuel oil all of a sudden. What's to stop the fleets in the Med not bunkering in Gibraltar anymore, but going to Ceyhan or even from Rotterdam?
It depends. It's basically diversion cost. If you're going to the
but once you do it once, it's fine.
No, it's still a cost of diversion because you're spending more fuel to go to Ceyhan. If you're transiting from Port Suez, Port Said at the top north of the Suez Canal, going to the Atlantic Ocean or going to Northwest Europe, to divert up to Ceyhan to pick up fuel is a fairly large diversion and adds more cost to your voyage. And that's
to the end user. To the end user.
Yeah, and that's off higher costs. So the ship owner actually bears that cost structure. So the only way that would work is that bunker fuel has to be so cheap to offset the loss in higher cost that happens from the ship owner to divert from the normal trade route into a third-party port.
Or you just send a load of barges, keep on, with the floating storage in Port Said.
Well, I mean, that's why I think you see a lot more bunker companies opening up in Port Said, is that
right.
The oil does move into Egypt that way. Therefore, you're hitting the bunker margin there and in Malta, the two big points on the transit, which are bunker hubs.
Okay. That's really one to keep an eye on, because we can talk, and we do, and rant, like I said, about, okay, look, this is what's happening with oil. But when it comes down to it, what does it all actually mean? Like, is anything fundamentally changing?
Well, it is fundamentally changing, because if you look at what's happened now with Europe sliding in a lot of light sweet crudes now to run their refineries to produce materials, we've created an overhang of naphtha in the European marketplace. Now, naphtha being the light in straight run barrel, there's a lot of different species of naphtha. You have your straight run naphtha, your full range naphthas, then you have your light cat naphthas and coker naphthas that come off of different secondary processing units that are more akin for gasoline blending than for petchem processing. But nevertheless, you have this big overhang of naphtha in the EU. And why? Because your outlet into the Far East is not there anymore.
Yeah.
The pre-war flow was naphtha was produced in Europe and would usually transit into the Far East, which then would be thrown into petchem processing in China, other locations in Asia to make plastics. That's it in a nutshell. Now that you have all this Russian crude and Russian naphtha being exported going into the Far East, the exports from the European refineries have no home. And so you start ending up with a bottlenecked refining system where your input material starts finding problems around the removal of one of the outlet products that you make when you run crude oil, naphtha. Yeah. Now, the problem you have with naphtha in the summertime is people would say, well, that should just go into gasoline blending. Well, you can only get so much naphtha, straight run naphtha, into gasoline, and this is due to what's called the RVP, reed vapor pressure. It's the biggest constraint. During the summertime, your RVP in the United States goes from a 15 RVP during the height of winter to, in some locations, a 7.5 RVP. Some locations, 9 RVP. So this is the amount of vapors that come off the gasoline as it sits in a tank. And the reason why it's a specification that's measured is that back in the day when people had actual carburetors, not fuel injection, the amount of gasoline vapors, if you had too much vapors, you'd have vapor lock in your engine where you would have an improper mix of oxygen and gasoline to make combustion happen.
Edwards 101, it's back every episode. Here we go.
We touch on all type of engineering topics.
Yeah, love it. Go on.
So now that we have this overhang of naphtha, my question is, at what point do we start to two block refining exports because there's nowhere to put the naphtha?
Yeah.
And have we seen storage fill up? Do we see, does the contango and naphtha deep into the point where you end up with floating storage economics? Last time I checked the naphtha curve in the front, it was -$6 a ton contango, which is just enough to basically to cover your basic tank costs, but not so much for all your financing costs.
Yeah, I mean that's supportive of freight then, because the more
freight.
Yeah,
especially clean freight.
Yeah, absolutely. Okay, well, look,
not that we called world peace today, but I see from the clock on the wall that it's we've come to the end of another.
It's a shame. I could have ranted for days. No, look, we're actually seeing each other tomorrow in Geneva, so the smoking barrel unites. No, it's nice. Like I said, I'm doing my bit for jet fuel demand. But look, a muted reaction on OPEC cuts, largely expected. And what more can Saudi do? The Russians are sort of going along with it, because they need allies. I expect a fairly range-bound market until we see each other again next week, viewers.
Yeah, I mean, I don't see much breaking this out unless you get some type of massive change in the supply stream. I mean, so 77, 75, 77, 73. I think that range sticks for the rest of the year.
Yeah, well, we'll have to see. I mean, like I said, it's all about what happens with demand, then people adjusting those demand outlooks, which were so bullish for second half. I think then we could see some reaction. We could pop down to the 70s on Brent. But yeah, look, happy 4th of July to all our American viewers, especially you, Rusty.
Thank you.
And we'll see everyone next week. I'll see you tomorrow.
Yes, everybody have a good afternoon, good day, and catch the Smoking Barrel, like and subscribe.